Welcome to Growth Investing Mastery. This video will look at my May 2026 growth stock portfolio review. As a reminder, this channel is not investment advice or recommendations. These are just my opinions, and the channel is completely independent. The purpose of this video is to review my growth stock portfolio at the start of June 2026. I will examine decisions I made on buying, selling, and holding stocks. And I will evaluate earnings reports on my companies which reported recently. Getting into my allocations for the month, I have 4 high confidence positions. These include Astera Labs at 16.6%, Credo at 15.2%, AppLovin at 14.3%, and Iren at 11.4%. I then have a number of medium confidence positions as well. The first being Silicon Motion at 8.5%, Pattern Group at 6.8%, Micron at 6%. Then I have Reddit at 5%, Kulicke and Soffa at 4.9%, FIGR Technology at 4.8%, and Ethos Technologies at 4.2%. I then have Cohu at 1.3%. And lastly, I have here something I listed as foreign listed semiconductors at 0.5%. I started some small positions in semiconductors, which are only listed on local exchanges overseas. And I will detail later in the video which names I've included in this international part of my portfolio. Taking a look at my portfolio changes on the month, I added to Credo, AppLovin, Silicon Motion, Pattern Group, Micron, and FIGR Technology this month. And I trimmed Astera Labs, Iren, and Ethos Technologies. There were 2 new stocks in the month, which were Cohu and Kulicke and Soffa. I also bought and then sold back a number of stocks this month. These names included Applied Optoelectronics, Figma, Forgent Power Solutions, ACM Research, and KVHI Industries. I then sold 8 of my holdings in the month. These names included XTIA Aerospace, Electrovia, Allegro Microsystems, SanDisk, Dave Inc., Viant Technology, Lumentum, and TOYO. And I will have shorter sections on the sales this month, as there was a lot of turnover in my portfolio. But I'll still give the rationale behind my sales for the stocks I sold. And I'll look to focus more on the current holdings rather than what's not in my portfolio. Now let's check out how my results look at the end of May 2026. In 2026 so far, my portfolio is up 50% year to date. This is on top of getting 146% returns in 2024 and 112% returns in 2025. And I'm really starting to see the power of compounding, as my cumulative return since the start of 2024 is up 683%. If we look at my year-to-date point-in-time returns, we can see how it's been a bumpy ride this year so far. In January, I started out being up a small amount with 4% year-to-date returns. But February and March were really tough months for my portfolio. At the end of March, my portfolio was down 20% year-to-date. However, April and May have been really strong months for my portfolio, as I finished May being up 50% year-to-date. It's important to keep in mind with my investing style, it's not a straight line up. There's a lot of variance with my investing style. As we can see, in March I was underperforming the market. And now as the market recovers, my portfolio is significantly outperforming. Let's now take a look at my market and portfolio commentary on the month. So there's been a lot of talk recently if the market's in a bubble, and a lot of debate about the AI cycle and how long that may go on for or when it may end. When I look back at when I first started investing in the late 1990s, there was also a lot of talk about a bubble. The biggest strategy mistake I made as a new investor was thinking that I could not buy into a stock that had risen this much. I would see companies like Amazon, Yahoo, and AOL rising nearly every day. It seemed like every day they would be up 10 or 15 points, and it just didn't make sense to me. I thought these stocks were untouchable and surely I cannot buy in now. At some point, all three of those stocks did stock splits, and the stocks rallied even more on the stock split. After those same stocks split, they still seem to go up every day. And the percentages these stocks were going up after they split was even larger than before they split. So I thought all those market winners were completely untouchable. Additionally, there seemed to be broad market consensus that the Nasdaq at 3,000 meant that stocks were way overvalued already. And that's one difference I see with the market back in 1999 versus now. Back then, almost everybody was in agreement that the market was overvalued. And I think right now there's more of an ongoing debate where some people think it's overvalued, and then other people think it has a long way to run with AI. There's one potentially counterintuitive part of my strategy, which is that we want to be in market leaders, which often means buying in at all-time highs for a stock. One way to determine if a stock can be a market leader is if the Nasdaq is up, this stock is usually up way more than the index. Some key takeaways are that I want to be in stocks the market can rally behind, like semiconductors and memory stocks. I also look to be in companies that are leaders in innovation. I'll ask myself, is this a stock that can 3 to 4x in the near term of 1 to 2 years? Or is it a stock that can 10x a few years after that? Another question I like to ask is, does this company seem like the next big idea? The market is heavily narrative driven recently. I'll look to confirm that each stock I own has tremendous upside, and the stock must have accelerating financials, or at least be guiding towards that. This gives me confidence that the business is executing and not just talking a big game. Strong underlying financials provide a safety net if the market gets tired of this story. But how do you know when to get out of a company? Everybody remembers the massive market crash in the year 2000. In my strategy, I wait for the company to deliver poor results or give weak guidance. This involves zero guesswork. And this way, no cognitive energy is burned guessing and speculating when the AI cycle will end. And in turn, this is why my strategy is agnostic if we're in a bubble or not, or if the AI cycle is going to continue or not. Jumping into the stocks I own, my highest allocation position is Astera Labs with symbol ALAB. Their product is next-gen AI networking infrastructure, and this is a company that I view as having incredible upside in the long term. Astera Labs reported earnings in early May. The previous guidance on revenue was from 286 to 297 million, and they landed at 308 million, which was a number I thought was just okay. But the next quarter guidance came in better than I expected, as they guided from 355 to 365 million, which would be up 84% year over year and 19% quarter over quarter. However, Astera shines even stronger in narrative than financials from my perspective currently. And the recent investor conference I reviewed as a post on my YouTube channel detailed how Astera is at the center of next-gen systems. Both the Amazon Trainium 4 and the AMD MI500 systems are reliant on the Scorpio switch. The Scorpio switch is a one-of-a-kind product that management called completely greenfield. Without Scorpio, these Amazon and AMD system designs would have to be scrapped and completely rethought. The Scorpio switch is not a commodity product. It can't just be swapped out for another competitor's product. And it's starting to make sense to me why Amazon was so keen on investing in Astera Labs. The investment arrangement with Amazon specifies performance incentives related to Scorpio. Amazon wants Astera to be able to deliver the Scorpio switch at massive scale, and Astera is now going into technical details on further product enhancements. The Scorpio switch has something new called in-network compute, and the management detailed some other advantages as well. This makes the Trainium and MI500 chips more competitive in the long run. AMD's surging sales are a great sign for Astera Labs. And AMD is also dependent on Astera Labs now to catch up with NVIDIA. So both AMD and Astera Labs' destinies are now tied together. Another high confidence name I own is Credo with symbol CRDO. They make next-gen networking AI hardware with an expanding optical presence. And this company is a peer to Astera Labs, although their product sets have diverged recently. One interesting statement I picked up from Credo's last earnings report was they said that AECs are increasingly displacing laser-based optical modules. And that goes completely counter to the market narrative that optical is replacing everything already. When talking about near-package optics, management said that until NPO can deliver bulletproof reliability, deployments of that technology will be limited. On the other side of their product lineup, Credo has zero-flap optics, and they say their solution delivers 1,000 times better reliability than commodity laser-based optics companies. They detailed how zero-flap optics also uses half the power, and they said network reliability matters. Downtime can cost millions. Progress with the company's zero-flap optics is ahead of schedule, and they expect a big ramp in Q1 fiscal 2027. And keeping in mind the company is just about to report Q4 of fiscal 2026. And they said the product roadmap for zero-flap optics got pulled in 6 months. Additionally, they detailed how strong the demand is from their customers. They talked about this is the first time any solution has gone up the stack to deliver real-time telemetry for optics. Regarding zero-flap optics, they said, "We think this is going to be such a strong ramp throughout fiscal 2027. And they talked about how new products meaningfully broadened our near to long-term opportunity. While the narrative for Credo is really strong, the company has been delivering really impressive financials as well. Adjusted net income was up 63% quarter over quarter on their last report, and that profitability is even outpacing the revenue growth, which is an impressive 52% quarter over quarter. I recently just completed my earnings prep work for the earnings report coming up on June 1st. The company guided revenue from $425 to $435 million for this upcoming quarter they're about to report. Analysts are looking for the number $433 million, but I'm looking for revenue above $455 million to be satisfied. Next quarter, analysts expect $465 million as the guidance number. But I'll be looking for Credo to guide above $515 million for revenue at the top end of their guidance range. And I also think there's a realistic chance they guide well above $515 million because of the zero-flap optics ramp. The next company in my portfolio is AppLovin with symbol App. They make an ad tech platform for free-to-play games, and they're expanding to consumer and social media now. The company's new social media platform is called Gist, which was recently announced. It takes a referral code to sign up for Gist right now. And I will be interested to see if the company does paid marketing for their new Gist platform or not. My take is there's mostly upside to this announcement. But it does lead to this question of, can they create a superior social media platform and get users to onboard? The company has shown great expertise winning in the marketplace with a superior ad tech platform in the gaming arena. Another important point to understand about AppLovin is the general availability for the consumer and e-commerce platform should be launching any day now. They gave June 1st as the starting date for general availability. And much of the upside in this name depends on a successful implementation of this consumer or e-commerce side. Another question I have is, can they reach the ROAS tipping point, as they called it? ROAS is return on ad spend. And as I understand it, the tipping point may mean a few different things. The first part of the tipping point is where a customer wants to keep reinvesting as much as possible and spending up on the AppLovin platform. And the second part of the tipping point is where it becomes a mistake for a business to use a competitor's product, such as using Meta. If the company can really reach this ROAS tipping point, there may be a whole lot of upside to this stock. And June will be the first full month of general availability, which will end up getting included in the Q2 results. The other outstanding question I have is, will the company finally be able to give a guidance of a big step up in Q3, or will management be more cautious still? The next company I own is Iren, with symbol IREN. They are a neo-cloud with an expertise in power and construction. The company recently had an earnings, which was one of the more challenging earnings reports to judge objectively. And I've gone back and forth on my opinion a few times about what to make of this earnings report. The Bitcoin revenue falling off was predictable, but the cloud revenue was a bit lower than I would expect. However, I did view the NVIDIA contract as a one-of-a-kind contract to build a flagship facility. And the compute here is for NVIDIA's own capacity. And that's what makes it different than other NeoCloud deals. The design of the facility will most likely use NVIDIA's most recent reference designs. Iren also detailed how they're expanding to the EU through Spain and to APAC through Australia. Iren's Mirantis acquisition leads to be able to providing more software and infrastructure solutions out of the box for their customers. And my viewpoint is they are solving the harder part first, which is the power and the data center build out. A few key takeaways for me are this stock is likely to be a narrative-driven company in the short term, but I do expect a more numbers-based thesis to play out in the longer term. I did end up trimming a small amount after the earnings report, but then I reconsidered that the story is still intact here, and I'm likely to keep a significant allocation as I want to see how the next few quarters ramp looks. Now let's take a look at a medium confidence position I have called Silicon Motion with symbol SIMO. They make NAND controllers and other related memory devices. The company presented at the JP Morgan Tech Conference recently. They detailed there how enterprise MonTitan SSD controllers are winning with 2 Tier 1s and 4 additional customers. The 2 Tier 1s they are likely referring to are NVIDIA and Google, and that's encouraging to see they have 4 additional customers as well. At this conference, the management talked about how they have a complete portfolio for the automotive market. They said we service virtually every car maker around the world, and they also detailed how they have active projects with all 7 NAND makers simultaneously today. NAND makers are outsourcing projects to Silicon Motion. The company's boot drive has a competitive advantage. It can fine-tune security within its own firmware. The company also detailed how they have a more than 50% market share gain in PCIe Gen 6 solutions. They discussed how HBM4E and HBM5, or high bandwidth memory, have many customizations. This leads to significant benefits for Silicon Motion because they're able to provide those customizations. On the margins for MonTitan, the management said they're building a solution that's enabling us to get better margins on the solution side than ever before. Additionally, they detailed how the consumer side is expanding as well, with next-gen smart TVs and door locks. My big takeaways about Silicon Motion are that I find it incredible they landed both NVIDIA and Google for MonTitan, and I still see the stock as undervalued versus other hardware names. The next company in my portfolio is Kulicke and Soffa with symbol KLIC. I had a recent video on this channel going in depth on the prospects for this company. I also realized I was mispronouncing this company's name. after reviewing some audio transcripts from the company that they were providing. K&S, as they call themselves, makes wiring solutions for semiconductors, and they have an expansion into memory products. This company was not a growth company until recently. 2 quarters ago, this company had 20% growth on the top line for their revenue, but on prior quarters they had negative year-over-year growth. However, this most recent quarter saw 50% year-over-year growth, and then they're guiding up to over 100% year-over-year growth. About 3 months ago, I first heard of this company through a bare minimum screener and saw they had 20% growth. And I didn't think this company was even worth investigating at that point. So I was very surprised to see this name come through my main screener with over 40% growth, and this coincided with their earnings report. On the morning of their earnings report, I saw the stock was up in the pre-market to $108 a share, going up from the mid-90s on the prior day. I thought based off the press release alone, the stock could go up over 100% in one day. And the reason I thought that is similar stocks like MaxLinear saw incredible gains like this. However, I was completely wrong about my price prediction and where it may go. The stock price dropped back to earth once the market opened again. My viewpoint is the market did not reward this company nearly enough for this report. And as I mentioned, I've seen other semiconductor stocks rally so much more on reports that were not nearly as strong. And something to keep in mind is K&S is not a well-known stock by the market yet, but it could be if they keep delivering strong results. The company has a European peer or competitor called Besi, which has similar revenue, but lower revenue growth. Yet somehow the market cap for Besi is 5 times the market cap of K&S. And this is where I see a huge opportunity with this company. My next portfolio company is Pattern Group with symbol PTRN. They are a brand accelerator platform for e-commerce businesses, and I thought they had an impressive performance this quarter, beating the top and bottom line guidance. Revenue was guided from 710 to 720 million, and I was looking for over 745 million for this company to deliver. The actual land was at 774 million, which was up 43% year over year, and that was well ahead of my own expectations. On adjusted EBITDA, the company guided for 41 to 42 million, and I wanted to see the company get over 51 million on adjusted EBITDA. They landed at 54 million, which was up 59% year over year. Then for the next quarter, analysts thought the revenue would be guided for 762 million. I was looking for over 790 million, and it actually came in at 820 million. And I thought this was a very significant step up in revenue guidance that the company was able to give here. They also detailed how international revenue grew 101% year over year, and non-Amazon revenue grew 119% year over year. The company's other monetization strategies, as they called it, grew 173% year over year. It seems like this other monetization strategies is a broad grouping that includes their SaaS software solutions. Although it does seem like they rebranded how they call this, which is a little bit of a yellow flag for the company. R&D in the latest quarter was $10 million, which was up 77% year over year. They said they're doubling down on tech spend, and they mentioned how their agentic investments are delivering. I view it as a good sign that Pattern Group is investing in the business, and the company has a super clean balance sheet with 344 million of cash, no debt, and 150 million of borrowing capacity. Management says they have a huge TAM, which they called all digital goods sold worldwide. One of the key points for why I like this earnings report so much is the company's net revenue retention was 127% in this latest quarter. That was versus 124% last quarter and versus 115% last year. In prior calls, management told us that NRR is the most important metric to track for the health of their business. But the real reason that I thought this 127% number was so strong is on the prior earnings call, they warned investors that NRR would go down. And this is because of how NRR is calculated on a 1-year trailing basis, and they were lapping some difficult comps, it sounded like. One last thought I had is the company getting re-rated as a SaaS business with a logistics solution could increase the stock price. The next stock I have in my portfolio is Micron, with symbol MU. They are a US-based memory maker with expanding production capacity. And I wrote here that looking back, sometimes the market offers a layup in terms of opportunity. In December 2025, the company reported a massive acceleration in the business, and the price simply had not caught up in terms of the revised guidance. However, now the stock price has caught up and it's more reasonably priced. And this is a good example of why I do not want to view a stock as being out of reach simply because it went up. I sold Micron back in December 2024 for around $90 a share. And earlier in this year, I was buying back Micron in January of 2026 for over $350 a share. If I was incapable to reevaluate or held a grudge against the stock, it would be impossible for me to buy it back. Additionally, I added to my position this month, buying at a price of over $800 a share, as I wanted to get closer to my target allocation. And even though the stock price went a magnitude higher, the opportunity for this business is also a magnitude higher. I like that Micron is upping their CapEx targets and reinvesting in the business. I prefer Micron over SanDisk because I view Micron as more of an innovator. I see Micron as a true semiconductor, where my viewpoint on SanDisk is seeing them as more as a storage business that's benefiting primarily from pricing. On the portfolio management side, Micron has the added benefit to be the only large cap in my portfolio. This lowers the variance for my portfolio because sometimes the market trades small cap versus large cap. It also smooths out my results in theory. The next company in my portfolio is FIGR Technology, with symbol FIGR. They are a blockchain-based marketplace for tokenizing real-world assets. On their most recent earnings, I thought their current quarter numbers were decent, and the company started giving guidance, which I like a lot. This may indicate some aspects of their business are becoming more predictable as they scale up. The guidance they gave had the consumer loan volume growing 123% year over year at the top end, and that looks like a fairly obtainable number based on what they're currently getting with their operating metrics. The big standouts from this earnings report, from my point of view, came from some of the other metrics they gave. They had a record 80 new partners added, bringing them to a total of 387. And they said the 6th or 7th largest mortgage lender was included in the new partners. The reason I said 6th or 7th was at one point they said the 6th largest, and in another spot they said the 7th. I'm obviously not too concerned which one it is. With profitability, adjusted EBITDA was $83 million, which was up 192% year over year. That worked out to a 49.6 adjusted EBITDA margin, and it shows the strong profitability of the business. The company has $1.5 billion of cash versus a $7.5 billion market cap, so there's no need for any new capital for this business. I thought the company's FIGR Forge product they announced is interesting. It creates fractionalized loans into single liquid dollar amounts. They talked about how this is getting deployed across various blockchains, but I'm not too sure on the market or the TAM for this type of product. However, I do like that they have new product announcements often. I would like to see some progress on their blockchain stock market. This effort seems like it may have stalled out a bit, but otherwise I'm fairly optimistic about this business. The next company I have is Reddit with symbol RDDT. Their product is community-based social media. Recently I started the subreddit r growth stock investing for further discussions on growth stocks. I thought this was a good spot to discuss the strategy of buy what you know. This is the most classic Peter Lynch strategy that he mentions. And I've been using Reddit since all the way back to 2013. And my viewpoint on buy what you know is that it's a good tool to have in the toolbox. But I don't look to overuse this. It's too easy to become a fan and then be biased in favor of the stock. If I really love the product or the company, it may be hard for myself to sell it later. However, anecdotal information can be useful up to a point. And my experience with setting up a subreddit was it seemed like a lot came out of the box in terms of moderation and support. I found the process to be fairly straightforward. I found out some of the rules for the subreddit can be auto-enforced, and it's done through an LLM. But I did notice the AI was overcorrecting through this mechanism. It took the rule no dollar amount mentions to mean you should not use company metrics for dollars. So for example, if I said a company had $50 million of adjusted EBITDA, the LLM was auto-enforcing that this was a violation of the rules. But really my intention there was that users don't mention dollar amounts for portfolios or share counts. So it did seem like that AI auto-enforce is a bit clunky, but it's probably going to improve over time. And I did get some feedback that some users not signing up through email got auto-assigned a username. At first, it seemed like a questionable move by Reddit to lock in a user with a generic name they may not want. But on second thought, it probably speeds up onboarding and improves funnel metrics. And one last point here is that the next update I give on Reddit will be more analytical. But it's rare to get such strong anecdotal evidence for a company I'm holding. The next company I own is Ethos Technologies, with symbol LIFE. They are a life insurance platform that can sell directly to consumers. The stock price has been on a real roller coaster ride since before earnings and after they posted. And the price action is probably like that because there's a lot of potentially contradictory information to take in here. On the most recent earnings report, the company had guided revenue from 144 to 146 million. I was looking for revenue of over 155 million, and it landed all the way at 193 million. I could barely believe my eyes when I saw that number. Yet the upcoming guidance they gave seemed to make no sense though. They gave a range of 114 to 118 million for the next quarter. And while I knew there was significant seasonality to the business, it shouldn't be that much. And I have one pet theory here that the company may have given soft upcoming guidance on purpose. For NASDAQ compliance, the exchange suggests that companies pre-report earnings if they are materially overperforming versus previous guidance. And I thought they may have given that soft upcoming guidance so they didn't need to raise their full year guidance amount by such a staggering amount. But this might be a best case interpretation of what may have happened. Another issue that came up is there's a partial early release of some locked up shares for 25% of the locked up shares. It is a somewhat unusual arrangement to have an early lockup released for only a portion of investors. And it's not great the stock price tanked in the coming week after that early lockup release. But not all outcomes here are bad news. For example, there might be a hedge fund that was invested early and they need to exit for a margin call elsewhere. That also might be a best case scenario. A worst case scenario might be that insiders know something is wrong, although I'm also doubtful of that outcome as well. It's also worth considering that shareholders that were locked in saw the stock price rise from $10 to $30 quickly. And there was also a short report that appeared on the company. I think it's worth checking out for myself, but it's not urgent in my viewpoint. And the reason it's not urgent is I saw one of the top level points they made in the report. It was that the company acquires customers so much through marketing, but that's already public information. And in my viewpoint, a short report loses credibility when they have a take that's publicly available in the sales and marketing line item. But to be fair, this many new question marks does not inspire a whole lot of confidence here. However, I'm still confident this company can overperform on their next earnings versus the seemingly soft guidance given. My next company in the portfolio is Cohu, with symbol COHU. They make semiconductor test and inspection products, and they are a US-based company that's headquartered in San Diego. The active install base of the systems serves 25,000 systems. That's across 280 high-volume manufacturing facilities, and it breaks down to 108 customers in between 31 countries. I found it really impressive they have no customer that counts for over 10% of revenue. There's also a wide variety of end markets, including compute, networking, auto, industrial, mobile, and consumer. Their products help deliver high yield, improved productivity, and lower cost to test. Cohu's largest production facility is in Malaysia, and they partner with Jabil on some production. There's also additional volume manufacturing in the Philippines, Singapore, and Japan. And my big takeaways here are the stock just seems way too cheap, with a market cap of $2.5 billion. And some semiconductors with less revenue than Cohu trade for 5 to 10x the market cap. The guidance given is a big step up for them. It's plus 34% year over year and plus 15% quarter over quarter. And this is for a company that was not previously growing that fast. The company's definitely not priced like a growth stock currently, but the market could re-rate them if they're able to get that 34% or higher on their revenue growth rate coming up. Let's take a look at the last stocks that I own, which include some foreign semiconductors. I had been looking for a while to get set up on Interactive Brokers to get access to these locally listed names. I'm still learning how the currency conversions work and how the whole process works, so I'm starting out pretty small here. And while 3 out of the 4 names are from Taiwan, this isn't a directional investment on Taiwan. It's just that some of the best names show up here. The first stock on my list is actually a Norwegian optics stock called Smart Optics. They have symbol SMOP.OL, and they offer a variety of optical connectivity products. Revenue in their last quarter was $22.9 million, which is up 60% year over year, and they're slightly profitable on a GAAP basis. The gross margin was 48%, and the market cap for this company is $600 million, so it's still a small cap. From their latest earnings transcript, it sounds like they have strong bookings with Tier 2 customers, as they called them. Many of their customers are based out of the US as well. It's also a founder-led business, which I like. Another company I bought is VISN Electronics with symbol 8299.TW. They are one of the main competitors to Silicon Motion, and they work with flash memory and controller integrated circuits. The company has a great set of metrics with revenue of $1.28 billion USD in the latest quarter, which is up 196% year over year. They had net income of $475 million and a gross margin of 62%. A market cap of $18 billion gives them a run rate price to sales of 3.5. Even more surprising, next quarter, analysts are looking for $1.89 billion of revenue, which is up almost 50% quarter over quarter. The next company I purchased is called AData Technology with symbol 3260.TW. They do fabless DRAM and SSD branded products. I found out both Silicon Motion and VISN sell finished products to AData, who further improve that products. AData has one of the most stunning revenue and profitability metrics I've ever seen in relation to its market cap. Revenue was $817 million, which was up 163% year over year and 62% quarter over quarter. The company has gross margin of 56% in the latest quarter, net margin of 37%, and a market cap of $4.3 billion. Analysts are also expecting a big step in revenue in the next quarter, growing 32% quarter over quarter. In calculating the run rate price to sales on the current quarter, this company has a PS ratio of just 1.3. It makes zero sense to me, and I see the company as being dramatically undervalued. The last company I have is Transcend Information with symbol 2451.TW. They make memory and digital storage products, and they're a manufacturer that has their own fab. The financials are shockingly impressive for this company as well. Revenue in the latest quarter was $427 million, which is up 357% year over year, and up 97% quarter over quarter. They had an impressive gross margin of 76% in the latest quarter, a net income margin of 60%, and a run rate price to sales of just 2.7. And feel free to let me know what you think of these foreign listed stocks. I know some people don't have access to be able to buy those, but I'd be curious to know if these stock names I just talked about are interesting to listeners out there. Let's take a look now at companies I bought in May and then sold back. The first is Applied Optoelectronics with symbol AAOI, and they make optical transceivers. I bought in about a week or so after the company reported earnings. And I didn't buy in before the earnings because I expected the company to underperform on the current quarter. And that kind of played out the way I was expecting, where they barely made their guidance range on the lower end. Yet they moved up their year-end target number for revenue and their monthly mid-2027 number. This convinced me briefly that I might want to take a position. But there ended up being too many other question marks with this business. The company's 800G transceiver product line only had $4.6 million of revenue in this latest quarter. And this is supposed to be their signature product or best-selling product coming up. Even on the prior quarter, analysts were asking why their 800G revenue was so low. And the management team seemed to dodge a question, being unwilling to give what the actual number was for 800G 2 quarters ago. This last earnings report discussed how their top 3 customers make up 95% of revenue. The breakdown was a 44% customer, a 26% customer, and a 25% customer. But the 44% customer is on the cable TV side of the business, and I believe it's Charter Communications. The cable TV side of the business overperformed this quarter as well. This means the company had less than $100 million of AI-related revenue in their latest quarter. And I wrote here, is their plan really to keep naming big numbers in the future while the business underperforms? I found it very strange this company continues to raise their guidance while they keep having unimpressive quarters. The next company I bought and sold in the month was Figma, with symbol FIG. They are a SaaS platform for design and project management. They posted a fairly impressive set of numbers recently on that last earnings report. Revenue was $333 million, which was up 46% year over year, and they're guiding next quarter to $350 million, which would be up 40% year over year. NRR came in at 139%, which is their highest ever. They mentioned that paid customers is 690,000, which grew 54% year over year. They said there's an outperformance versus our expectations, and that goes across product lines. My big question mark here is I'm not sure the market can rally behind this stock being in SaaS right now. And I want to see how the profitability numbers stabilize post-IPO now. The next company I bought and sold in the month is Forgent Power Solutions, with symbol FPS. They make customized electrical distribution equipment. The numbers are really impressive on their last report. Revenue was $379 million, which is up 103% year over year. Bookings came in at $867 million, which was up 308% year over year. And the backlog is $1.98 billion, up 157% year over year. The company has scaled up impressively, but I'm wondering, can they continue their pace of expansion without headcount increase? The company's backlog seems really small compared to their $15 billion market cap, despite the big growth. And the reason I say the backlog seems small to me is because when I was investing in a competitor called PAL about 2 years ago, that company had a bigger backlog than their market cap when I started investing there. Although it is worth keeping in mind, the market has re-rated many of these power distribution type of companies recently. Let's now look at some more stocks that I bought and then sold back in the month. The first one here is ACM Research with symbol ACMR. They make semiconductor wafer equipment for cleaning and surface preparation. Revenue in their prior quarter was $231 million, which is up 34% year over year. And the company is profitable with a net income of $17.3 million and a market cap around $6 billion. There's new product cycles for this company, including something they call a vertical furnace product. The furnace segment itself grew 205% year over year, and they said there's momentum in electroplating. As I was investigating this company, I realized that 99% of the revenue is from China, but that wasn't a total blocker. However, it was the company's corporate structure that was the reason for me selling. They own a Chinese subsidiary, or basically they own a full Chinese company. And the US company just seems like a wrapper or a holder company for the Chinese company. The really crazy part is the Chinese subsidiary on the local exchange trades for close to $15 billion. The stock symbol for the Chinese subsidiary is 688082.SS. This does seem like a really good arbitrage opportunity, but that's not the typical game I like to play. The last company I bought and sold in the month is called KVH Industries, with symbol KVHI. They sell maritime connectivity and content solutions using LEO satellites now. And LEO stands for the low Earth orbit satellites, such as what SpaceX is producing. Revenue in the latest quarter was $32 million, which was up 27% year over year. And the company is just slightly profitable, with a GAAP net income of $0.6 million and a market cap of $210 million. 85% of the revenue comes from services, and just 15% from hardware sales. The company sold a record 3,100 units in the quarter. That's up an impressive 70% over the previous record in Q3 of 2025 for sales. The company's total for subscribing vessels is 9,600, and that 3,100 number is not included yet in that total. There was one analyst on the call who was absolutely incredulous at this 3,100 number. He said, "That's a crazy number. This is a sort of crazy number." And later he was still confused. He said, "I'm just trying to get to the bottom. That's kind of a shockingly big number." But I ended up selling here because the LEO satellite has a lower ARPU number. The company also stopped manufacturing physical products themselves, and they're shutting down their production facility in Rhode Island. They're moving over to being completely services-based now. That's probably going to improve margins, but I had some other outstanding questions as well. They talked about pricing power, and it seems like SpaceX has some leverage over this company. I'm wondering if KVH is just a reseller primarily of some of these services. My overall larger concern is that SpaceX could rug pull this entire business. Now let's get into the companies I sold during the month. The first is XTIA Aerospace with symbol XTIA. They are a drone distributor serving commercial customers. My take is the management team made a series of missteps communicating with investors here. They announced midweek when their earnings would be, and it was only 2 days later. The company's earnings call again did no prepared remarks, and they referred investors to the filing to track down the prepared remarks. It's these non-standard type of actions that I really don't like from this management team. And XTI basically canceled their legacy business, while they acquired this company called Drone Nerds. Drone Nerds had an impressive set of financials before XTI acquired them. But my concern here is that the resulting company added a management layer around the Drones Nerd business. I'm not sure these extra employees working on the Drone Nerds business will provide value. But this stock is relatively cheap, and it could rise a lot if they land a big government contract. Another company I sold is Electrovia with symbol ELVA. They They make next-gen lithium-ion batteries. It's now 2 quarters in a row where revenue landed lighter than I was expecting. And I thought this company was at max production capacity 2 quarters ago, so I wouldn't really be expecting revenue to be going down now. They did talk about supply chain disruptions from the conflict going on. I am tempted to keep a position here because the Jamestown plant in New York is opening soon. Additionally, margins went up, and I still see this company as being undervalued. There's an interesting psychological phenomenon where I feel like this is a disappointing company to myself, partly because of the 2 disappointing revenue numbers in a row. But my original purchases of this company were below $5, and I ended up selling the company around $10 a share. So the actual result was more positive than my mindset around the company. Another company I sold in the month is Allegro Microsystems, with symbol ALGM. They make motion control sensors and power systems. But both the current revenue number and the revenue guidance came in lighter than I wanted. The prior call had detailed momentum in the business, but it just didn't show up in the numbers. One analyst called them out on this too. They pointed out that their guidance implies a slowdown in the data center. Another company I sold is SanDisk with symbol SNDK. They're a NAND memory maker, and they're seeing surging prices and demand. I view this as a great name to own with a lot of upside potential. But I kept thinking on the Micron versus SanDisk debate, and I ended up liking Micron slightly more. It just came down to that I view Micron as more of a semiconductor, while SanDisk is listed as technology, hardware, storage, and peripherals. While I understand that's just an industry label, it is somewhat indicative of the difference in the business models and innovation. I think Micron has been more clear on innovation and their expansion plans. And I mentioned on the Micron slide that the larger cap is a good diversification within my own portfolio. Although I have been thinking about adding SanDisk back to my portfolio, if another one of my AI-related stocks disappoints, this is likely a good candidate to add back to my portfolio. Let's take a look at some more companies that I sold this month. The first is Dave Inc. with symbol Dave. And I actually sold this company on the very first day of the month after producing my prior video. The company is a membership-based neobank for underserved customers. In the prior quarter to reporting, the company had $164 million of revenue, and I was looking for a sequential step up in revenue. Their current quarter revenue number landed at $158 million, which was well below what I was expecting. I kept going back and forth on this name, but something seemed off. Previously, the company never mentioned competitors, and then in one of their tech conferences, they name-dropped the Cash App and Chime as some of their main competitors. That was really surprising because I thought Sezzle, Affirm, and Klarna were the primary competitors here. It does seem like competition is stepping up in their industry, and it might be why they underperformed this quarter. The next company I sold is Viant Technology with symbol DSP. They're an ad platform for connected TVs and devices. And they told investors they absolutely crushed the trade desk. Yet I'm wondering where are their results? The company had guided revenue from 83 to 86 million. I thought this company was going to have a huge overperformance based on what they're saying, and I was looking for over 97 million of revenue. But they landed at just 88 million of revenue, which was up 25% year over year. The new guidance on the next quarter was to 101.5 million at the top end, which would be up 30% year over year. But this new guidance also includes some acquisition revenue. So overall, I felt this company was talking a big game, but didn't deliver the results. Another company I sold on the month was Lumentum, with symbol LITE. They have a number of optical-related products with an innovative optical circuit switch, it's called, or OCS. I kept getting hung up on this company that they only landed in the guidance range on the last quarter. They had guided from 780 to 830 million of revenue, and they landed at 808, or right in the middle of their guidance range. Yet the market has already re-rated this company so strongly, And that's maybe where the disconnect is for me as an investor. However, the next quarter guidance is for 1,010 million of revenue at the top end, which would be up 110% year over year. Overall, I feel the market has repriced this company already, and I'm considering the opportunity cost of missing out on some of the smaller names in my portfolio with their allocation. However, I really still like the innovation that Lumentum has with their OCS product. It's another company where I'm considering that maybe I should have a position here. The last company I sold is called TOYO, and the symbol is TOYO. They are a Japanese-based producer of solar cells. They recently reported Q1 2026 earnings. One thing that was a bit weird was their press release said these results are unaudited and unreviewed. It just means they're preliminary results, but I was wondering why they didn't wait until their auditor could sign off on them. The results indicated that revenue was 142.8 million, and that was way lower than I was expecting. The company previously reported in halves and not quarters. Yet in H2 of 2025, the company had 144 million of quarterly revenue if you split the overall number. But the Ethiopia factory only came online in October of 2025. So basically it meant that Q3 of 2025 had no revenue from the Ethiopia factory. And that's why I was expecting much bigger revenue numbers, so I don't really understand what happened here. I do see TOYO as being way undervalued still, and it could have a lot of upside as they expand to the US. They're building out their Houston facility right now, and if they get that up and running soon, it could provide upside to the stock. Let's now take a look at some promising new ideas. The first is Hinge Health with symbol HNGE. They are a physical therapy app with an expanding market. This company had a really strong report on their latest earnings where they beat guidance by 9 million. But then they raised their full year guidance by 62 million after reporting Q1. The company had a significant beat on the bottom line as well, with adjusted net income guided from 30 to 32 million, and this landed all the way at 46.2 million. But my concerns for this business fall into a few categories. The first is why they're expanding into medical devices. It seems like they have a medical device that treats migraines, and they're actually working with a contract manufacturer. The reason this is confusing to me is because I thought this company's innovation came from building superior apps. I also think there may be increasing competition from companies such as Omada Health. Omada is a similar style business model, but they deal with mental health. And I think there could be a lot of copycat apps in this space. And lastly, I felt that Hinge was providing a lack of info on Medicare or what percentage of clients are Medicare. It's still a small percentage of Medicare customers, so I don't think they're required to report this in their filing. But when I was looking at their filing and trying to track down the percentage of Medicare customers, it seemed like the company might be trying to obscure this, or they didn't want to say what their strategy was with Medicare. Another company I looked at is called VIAV Solutions with symbol VIAV. They do network test, measurement, and optical security. And this company is the other half of the JDS Uniphase breakup. It's worth knowing that Lumentum is the other side of the resulting company coming out of JDSU. And I never really understood what JDS Uniphase did back in the day, but now I'm starting to wrap my head around it a bit. Revenue was 407 million in the latest quarter, which is up 43% year over year, and the company's around break even on GAAP profitability. There's pretty good gross margins at 62%, and the market cap is 12 billion. The company said there's strong momentum in the data center ecosystem, and they expect this momentum to continue throughout calendar 2026. The market cap seems reasonable for this company, but other names are growing faster, and I think there may be some opportunity costs here. One more company I looked at is called VISN Networks with symbol VISN. They're an edge hardware provider for cable and telecom. This company is formerly called CommScope, and they sold off large portions of their business to pay down a massive 7.8 billion debt. CommScope was a company I never looked at because of how big their debt was. But now revenue is $472 million, which grew 22% year over year. EBITDA was $72.4 million. Although the net income was really skewed by the sale of the previous side of the business where it shows they have over $5 billion of net income on a GAAP basis. The end result is that this company has $2.5 billion in cash, and somehow they have a market cap of only $2.6 billion. I'm super interested that the market values this business as being worth nothing when you consider the cash balance that this company has. I would like to see how another quarter or two plays out since this restructuring, but this could be a really compelling opportunity moving forward. Let's check out some more promising new ideas. One company I was researching is called Diodes, with symbol DIOD. They make analog and power semiconductor solutions, and they're managing power conversion. On this latest earnings call, they had guided revenue for $395 million, and this landed at $406 million, which was up 22% year over year. Next quarter is guided for $436 million, which would be up 19% year over year. The gross margin seems pretty low at 32%. But the market cap is just $5 billion and the run rate price to sales is 3.1. What gave me some pause on this company is they said their 3-year target goal is $2 billion of annual revenue. But that would mean they're only getting $500 million per quarter of revenue. It does seem like a pretty sleepy and slow semiconductor here. But I kind of got the sense from the earnings transcript that the business is ramping up probably faster than the market expects. The next company I looked at is called ARLO Technologies with symbol ARLO. They make wire-free cameras, doorbells, and floodlights with recurring subscription revenue. Revenue in their last quarter was $150 million, which is up 26% year over year, and beat their guidance range. Net income landed at $14.9 million, and they had gross margin of 48%. The market cap for this company is $1.34 billion, so it's relatively cheap. And the hardware sales for this business make up 40%, with a 10 to 15% margin. However, subscription and services make up 60% of sales, and they have an impressive 84% margin here. So you can see they're not making too much on the hardware sales, but the subscriptions is where this business is really shining. The company said they had a truly spectacular quarter, and the earnings transcript seemed full of optimism. But I would like to see a bit of higher growth get posted first before reconsidering this name. One more company I looked at in the month was called Digi International with symbol DGII. They make industrial IoT products and services. This latest quarter saw revenue of $131 million, which is up 25% year over year. Net income was $11 million, and gross margins were 65%. The market cap is $2.4 billion, giving a run rate price to sales of 4.5. The company had $41 million cash flow from operations, and that was a quarterly record, up 58% year over year. Annual recurring revenue was $184 million, which grew 50% year over year. So that was really impressive that some metrics are growing over 50%. The company doesn't have any recent major acquisitions. But one thing I really didn't like was they said they did 11 acquisitions in 11 years. And this company looks to take on debt to make these acquisitions. When I see a serial acquirer like this, it often means the R&D organization is not working well at a company. Let's continue on looking at a couple more additional promising new ideas. One of these was called Advanced Energy Industries with symbol AEIS. They make power electronic conversion products. Revenue for the latest quarter came in at $511 million, which was up 26% year over year. The company had net income of $67 million, gross margin of 40%, and a market cap of $11.9 billion. The company's end markets include semiconductors, which make up 54%, industrial at 21%, data center compute at 19%, and telecom at 6%. The company did say they're seeing strength in the semiconductor side of the business, and the next quarter is expecting record revenue of $540 million, which would be up 23% year over year. My take here is there's nothing too exciting about this business. It seems a little bit boring and maybe fairly valued, but it is worth keeping an eye on, especially since they have semiconductor revenue, which seems to be growing. The last company I looked at is SiTime with symbol SITM. This is a company I've looked at a few times over the course of the channel and portfolio reviews. They make timing devices for semiconductors with growing AI benefits. Revenue in the most recent quarter was $114 million, which is up 88% year over year. And the next quarter is projected by analysts to be a significant step up at $146 million, which would be up 112% year over year. The prior analyst consensus for that revenue guide was $112 million. So you can see how much this company surprised analysts with their revenue guidance. On profitability, the company is getting close to break even. The company's communications segment grew 158% year over year and 17% quarter over quarter. And they're seeing some benefits from those LEO satellites, or the low Earth orbit satellites. Apparently each one of those needs a timing device. SiTime did have a big acquisition recently, acquiring the timing business from a company called Renesas for $3.2 billion. And SiTime raised over $1 billion of convertible notes recently. I like this business a whole lot, actually. But with the market cap around $20 billion, it is pretty pricey versus some other holdings I have. Let's check out my final thoughts on the month. As the market enters a more bullish phase, I look to place a greater emphasis on strong financials for the companies I'm investing in. This acts as a counterbalance to a narrative-driven market, but overperforming financials often goes in tandem with an exciting story. One example of that is Astera Labs, which says they're the mothership or the central nervous system of the data center. And it's great to see that combination of a strong story and accelerating financials together. More generally, I'm looking to avoid what is noise for my strategy. This includes macro, the AI cycle debate, or SpaceX. I view a stock reaching an all-time high as being a fine time to start a position. But it's also good if I find an unrecognized growing name the market is generally unaware of. There are so many companies accelerating their business from AI in one way or another. And the challenge for myself right now is to narrow down my portfolio to the names I see having the most upside. This concludes my monthly summary for the month of May 2026. As a reminder, this channel is not investment advice or recommendations. These are just my opinions, and the channel is completely independent. Thank you for taking the time to listen.